All right, good afternoon, everyone. How are the energy levels looking now that we're approaching lunchtime? Are you all here with us or looking forward to lunch? Okay, let me get started. And, I want to dive right in, Akshay. First up, how exactly has the role of AI sort of shaped up in the recent past when it comes to the fintech industry? Because like the host was also saying that AI, fintech, and tokenization are not separate tracks anymore, and they're now working together and helping the way money moves in today's day and age.
So I want to first break the myth, right? So there is actually no tokenization in fintech, right? Tokenization money is still coming in what you call digital rupee, right? Tokenization is only for KYC availability. The second part is what is called as AI was called as ML. The cost of technology to reduce OPEX came down dramatically low with the invention of, let's say, generative AI, right? Which means the efficiency of OPEX came phenomenally well in fintech, right? So, see, many of us who are, I call ourselves the baby bloomers of fintech. Right? The first company who started giving a digital on a mobile app 10 years back, when we said we want to give money fast, we were told, no, India is a very different context. You to assess the customer. If you're too fast, something will go wrong. We kept proving it could be done better. Today, let's say with more than a very large amount of scorecarding capability, millions of people who have come in, if you really look at how have we built the system to do AI-based systems to really assess the customer as the critical component. We have now received 4 crore people who have come to us looking for money. By design, that's a very large segment of population. While we say India is around 150 crore people, there are only, let's say, 12 crore which is formally possible to lend in modern world, right? And if you've already got, let's say, 25% of that segment, it's a large segment to make decision science on top of it. Then, if you look at the OPEX costs come down because of, let's say, generative AI, you can now do business in a more efficient manner. So, this is the time where fintechs are changing over the ball game. See, the cost of capital was the only differentiation in banking, at least when it came to lending. But now OPEX becomes a very large differentiator, which means you can compete with people who have a difference in OPEX cost versus cost of capital. Today, you will find efficiency by fintechs coming in a similar product line. You may actually get a fintech loan cheaper than a bank under a traditional institution loan. That's a dramatic change taking place because of OPEX efficiency, and that is coming because of new age technology capability of processing data, understanding the consumer, understanding operations, running business better. Look at a company like ours. We today should cater to the, let's say, 10% of India lending demand. There are only physical 21 underwriters in the company. That's it, right? If you consider that we should be having 1/10 of the underwriters in the country also. We only have 21 of them. We had maybe 16 underwriters 8 years back, right? We used to do maybe 10 loans hour. Maybe now we process, let's say, at least 100,000 applications a day, right? So the processing capability went up. Number of people just didn't get hired. Your OPEX cost came down dramatically well. Data cost has remained fragmented, but at the same time, you can assess far more complex data to do underwriting, decisioning, build new systems for customer understanding, and then really build lending more efficient.
Ganesh, what about you? How has adding AI changed the way things work for your customers? How the way product works for customers?
Thank you. Thanks for getting us started, Akshay. Just for context, I run a fund called Quona Capital. We are probably the first global fintech fund focused on financial inclusion. We invest across global markets, and India is arguably our largest market. So across portfolio companies, of course, we see an evolution, and we'll talk about probably both, but especially both the trends, but especially on AI, you do see an evolution on what is the impact of AI going to be on the financial services landscape broadly. Frankly, some of it is real, some of it is hyped, some of it is overdone. But fundamentally, if you take a futuristic view, number of the companies starting today or that have started in the last couple of years are really trying to figure out what AI native centricity and AI native business building means for them. In some cases, it makes sense. and frankly, in some cases, it doesn't. For example, we have uh, I'll give you a couple of examples. We have a portfolio company which is today the largest digital bank in Mexico after New Bank. It's called Clar. They have a couple of million users. Fairly sized up, scaled up company looking to go public soon. Fundamentally, they have redone all the operations and from underwriting to customer success to customer service to new product upsell, so on and so forth, largely in an AI native manner. What that does mean is it dramatically improves your efficiency and accuracy and ability to understand the customer, like Akshay was saying. What it does not do is is eliminate humans from the equation. So the art and science of this is how you leverage AI to really be able to juxtapose AI assisted human smarts to be able to serve your customers more effectively. And it's on a spectrum, right? On a scale of 0 to 100, in some areas we are seeing evolution. In some markets we are seeing a lot more maturity of going from this going up to 70-80%. And in some markets and in some countries and some products and some categories, we are still in early stages.
But what are the signals that tell you that an idea is actually workable and not just hype? The pitch versus execution debate. What are the signals that you're getting?
Yeah, it's a good question, and obviously, as investors, we are inundated with these ideas. The analogy I use is that at the turn of every big tech evolution, whether it's internet, whether it's mobile, whether it's cloud and cloud infrastructure, or whether it's in the early days of fintech when we first started, our fund. Um, you obviously see a lot of ideas. Frankly, 8 out of 10 of them would be hype because even the ecosystem orientation is how do I make myself relevant in the context of an up and coming technology. What we try to do, and we fail a lot of times, is to really figure out how to focus on the why and what. So what are you solving, and why can this be solved in a much better way? I mean, the classical tech challenges, can this be 10x? Now, I don't know if it can be 10x. There are different ways to kind of assess if you are providing a quantum leap better solution. So the what and why has to be answered for us for what you're building. And AI is then more a tool to really provide it in a lot more, lot smarter, efficient, and maybe cheaper and better way. But I think we need to first focus on the root cause of what and why.
I have the same question for both of you. Let me start with Akshay first. Where are you seeing AI and tokenization making the most amount of real world impact within the fintech industries? And are there any real life examples that you could share with our viewers?
So there are a large number of examples. One of the most common one is, let's say, collections, telecalling getting replaced by bots and to really service the consumer. But if you look at that, is just scratching the surface. What it's basically doing is taking the voice analysis capability, uh, getting a bot to call up, convert, and manage the customer experience, objection handling, and language in an assisted manner for the consumer. But if you look at behind this is actually the bigger element work happening. One of the first is the agentic interface. So first was to build a bot to do this work for you and build models behind it. But now what people are doing is they're building an agentic uh, interface to enable the bot. So earlier you had to need a team who will go build a bot, find out the result of it. Now you just instruct the machine, can you build a bot for me? And this is the variable I'm trying to chase. I want to see this pilot over the next funnel window of mine. Imagine you're running a pre-X window, you have 7 customer segments. It can run 7 of it differently. You didn't move from your table. It could deliver the result, which means the efficiency was not at the telecaller end. The efficiency was that the manager who was needed to drive telecalling is not needed anymore. So there is where the differentiation, the noise that we hear is the collections call are is placed by a machine. That is not the tougher ask, right? You're not automating a 25,000 rupee resource. What you're automating is the 5 lakh rupee a resource could design or orchestrate collections, right? That whole part, an agentic bot can step in to drive efficiency for you and then deliver what could be business outcomes. So I would say on the surface, a lot of noise are happening. Voice got moved to AI. In practice, majority of the companies are building the practice of doing that core role and using an agentic atmosphere to drive efficiencies of business against it.
Where are you seeing this kind of convergence taking place?
Say that again. When you say convergence, what do you mean?
Between, AI tokenization and working towards, the next big impact in fintech industry?
Yeah, that's a big question. So AI is one part of it. Tokenization is another. And in my view, they're both, you know, as big revolutions as the cloud infrastructure or as mobile telephony before that, etc. So they're two separate things, but in some cases they're converging. And so maybe I'll give you an example of convergence. It's still early, but actually, you know what? I'm going to give you a different example of a company that just went public in the US. It's called Figure, and people should look it up. It's Figure as in figure. So US is the largest mortgage market in the world. Figure is the largest non-banking mortgage lender in the world and in the US. So what they've done differently, it's a company that's been built in 7 years. They just went public this year. What they did differently, or rather what they did very similar to all mortgage originators, is they originate, underwrite, and issue loans. But once they do that, they put the entire loan on chain and they tokenize it. Now, tokenizing the loan has helped them do a few things. If there is Akshay, Karunya, and Ganesh, and we fall in different profiles, they have been able to create different buckets, and programmatically, these people can be put into different buckets. Once the pool reaches a certain size of few $1 billion, the pool which has been tokenized can now be sold to multiple parties. In the past, if it's off chain or in fiat world, it could only be sold 1:1 to a party. And it's very hard, as we all know. Anybody who's tried to even sell one home knows how illiquid a home is. So imagine selling pools of billions of dollars or thousands of crores of loans. Now being on chain, liquidity has gone up. You have fractionalized it. You're able to sell it to multiple parties. You're able to programmatically figure out which pool has what characteristics and which buyer wants what. You are able to monitor and service it a lot more easily in a more automated manner, which means when people are paying interest or principal, you are able to fractionally be able to assign it to all these different buyers. And you're able to also sell it, pass it on further. So they have dramatically changed and they're able to securitize all this a lot more easily. So they can take $100 or whatever, let's say a crore, and they can rotate it a lot more than historically any home lender in the world has been able to do. Right? And this is a public company now, so you guys can all look up the information. The two big things where they have dramatically been able to build a company differently, one is tokenization. The second is the company is built on initially on less than 100 people. And a lot of that was being able to take all the historical data of home origination in the US to the extent possible. And frankly, it's a more structured market, so data is available. But with that, and they were able to leverage AI to be able to take that data, translate it into a form of intelligence where they then say which are the focus segments we want to go after to be able to do this the way we want to operate, right? So it just helped them build top of funnel and design the product in a lot more effective way. It did not, and what that meant is you are able to build a lot more focused company as opposed sort of starting with home finance in a lot more broad-based way, and then figure out as you go along what segment, what product, and how to build my liability asset book, so on and so forth.
Akshay, what kind of business problems is all these technologies been able to solve for your particular business and the way you do your work? If I'm not wrong, I think Fibe is running at 96% automation today. Is that right?
Yes.
So tell us what that actually means for your operations, your customer experience. How have things evolved given, how these technologies have also shaped up and evolved over time?
So I'll give a very interesting example, right? We always said, personal loans are supposed to cause impact. But when you transfer money to your customer's bank account, you can't really identify the impact. Right? So one of the first parts we did is let's start monitoring the end use case, and we came up with the idea of healthcare financing. We nicknamed it surgery finance. So today you can walk up to any of the large hospitals in the country. There are almost 10,000 touch points here, where suppose you want to get a knee replacement done, or you need to get a stent in the heart put, right? typically when you walk up, your insurer will take 4 to 8 hours to give an authorization before your treatment starts. And when you want to exit the hospital, they'll take 12 to 16 hours before they can settle the treatment. Right? We said this is a fair amount of friction. Majority Indians are underinsured or don't have insurance. What we did a capability was doing a runtime loan, managing the health records and the financial records of the customer. Imagine walking up to a hospital, entering into the billing system that, listen, I want to pay this with Fibe, right? You should just say that word. He enters one button on his core system. The medical transcript along with the financial data moves to us. Within 3 milliseconds, we approve the transaction and you can start treatment. The authorization, or what we call as a classical DO, is received into the system of the healthcare providers. Now that's resulted in some very interesting results. The first, let's say when you want to get a knee replacement, that's a very known problem that as you have aging, let's say parents, they will need knee replacement done. It's a 4-hour per knee operation. The insurer typically covers it, but the insurer doesn't cover the robo on it, which improves the efficiency for the surgeon. What we did is we worked with the surgeon, we worked with the implant manufacturer, we worked with the hospital, and today across, I think, all the centers where this is actually done, you will find a zero cost EMI working with us. The end-to-end turnaround time is 3 seconds. Imagine you go to the hospital and you say, listen, I want to get a robotic surgery. I'm just opt by Fibe, right? The money will reach the hospital, or the tokenization of the money will reach in 3 seconds and the treatment will start, right? Your insurance money may come after 12 hours, right? But the money to start treatment from a lender reaches much faster. You can get the treatment started. Now that is causing a great amount of differentiation. So some of the examples came in let's say cities and transactions. So when you go to Chennai or T Nagar, all the 7 large hospitals are on one single road, which do knee replacement, right? The first started saying this, all 7 of them today give this feature, right? The consumer has a state understanding. I no more want to get knee replacement without the machine, right? The doctor wants it because he can prove a much better efficiency. Results of him are upwards of 99%. At the same time, a lender came as an invisible product. Just like you can buy mobile phones on EMI, why can't you get knee replacement on EMI done in a faster manner, right? And some of these systems were not possible, let's say a few years back. Combining a health record with financial data is like combining, let's say, weather patterns with crop productivity, right? It's very difficult to do the answer. But today we have been able to find results, we are able to do a disproportionate amount of volume, and also been able to get the end use case behind, where we actually gave money for a specified treatment coming in. So what was called impact got demonstrated as impact, what was called impossible on technology got delivered, and what was enabled at a low OPEX because the efficiency of technology got result was a one single answer coming for the end consumer.
Great, that's really interesting. Ganesh, how about you? Which parts or segments of the fintech industry do you see reshaping first as these technologies catch up and evolve further?
Sure. So it's happening across the board. And I'll give a couple of examples from our India portfolio and Asia portfolio. But in general, whenever such a fundamental tectonic shift happens, the future is actually with us in some ways. It's just unevenly distributed. In some categories, it's actually moving forward very rapidly. In other categories, it takes time, just given how the ecosystem and incumbent infrastructure is. So if you take AI, one is how are companies leveraging AI from an internal perspective. We can, and I don't know how many of you were listening to Sahi's presentation earlier today. The founder was talking about how lean the team is and how much they have scaled. So fundamentally, companies which are figuring out how to leverage AI and AI native workflow and operations internally have a huge advantage over the rest. And number of the newer age companies coming up, we are seeing that already being, it's become a way of working for a number of these companies and significant advantage. So whether it's Bureau.id in our portfolio, which does fraud monitoring, or Upswing, which is built one of the more interesting financial infrastructure companies that works with number of the banks and fintechs. So on and so forth, or even Shivalik Bank, which is one of the interesting small finance banks that we are an investor in. How do you rewrite some of the operations internally to gain great degree of efficiency and, more importantly, insights to serve the customers well? It's becoming par for the course. On the external front, I think the market is moving a bit slower, I would say, than we would have expected in some of the markets. But when it comes to some of the high frequency activities, especially around investing and trading, we are starting to see the market move much faster on that. So there are some pockets where it's moving, and I think the rest will catch up over time. Right? If you talk about tokenization, I think there we are seeing a lot more action across markets like Singapore, Hong Kong, even UK, Australia, etc., rather than in India. And I guess one of the fundamental challenges we have is, and by the way, again, I don't want to start a quiz question, but one of the oldest forms of tokenization was actually first done in this country, in the modern world. It was first done in the US in 70s, and it was done in India in 90s, and that's basically demat of shares. That's basically what tokenization is, where it helps you create a digital token and then be able to make it a lot more usable and distributable and frictionless and fractional, and create higher liquidity. Now the challenge we have is, if you look at where we are with tokenization today, there is a fundamental a protocol or flow of digital currency, which will help make tokenization effective. So if we go back 25, 30 years and think about the advent of internet and how TCP/IP was the protocol or flow of information that helped make it happen, stable coins is sort of flow of the information, flow of currency, and flow of transaction, which will make tokenization happen in this world. The challenge we have is we are still figuring out where we stand from a regulatory and implementation point of view on that. And I think we'll have to figure it out soon because the world is moving.
Yeah, I'm glad you said that, because that segues into the next question. Because up until now, we've painted the picture about what's happening, what's the potential within the space. But Akshay, if you would also like to tell us a bit about the areas of friction. Is it customer adoption? Is it regulatory concerns? Or is it the technology? Where is the most amount of resistance or challenge that you see?
So I think India is a very interesting market. I think the regulator is the biggest disruptor of category. He pushes, I would say, the startup community to think out of the box, because he's innovating faster than you are, right? At the same time, India is a very interesting consumer segment, that they adopt and accept change in a very good manner, right? The way adopted, let's say, digital identity, the way we adopted the way of doing KYCs, opening accounts, opening DMATs, investing, opening digital FDs. We have seen a great amount of consumer acceptance taking place in the market, right? Now, the majority of the issues that we face are more internal challenges, right? Are we willing to adopt to things that fast? I'll give an example. DLGs happened, digital lending guidelines came twice to make two dramatic changes. Right. First one, how business model runs, and the second was linked to how you operationalize visualization of the lending product, consumer facing rates, as well as the co-lending arrangement. Now, if you look at technically, these are very transparent from the consumer perspective. He always said, I want to know where I am borrowing from, who I am borrowing from, and what rate am I borrowing from. So this was not very different, right? So the consumer isn't asking for too much of a complexity. It's majority that the companies who are innovating are not innovating as fast to provide the solution for the consumer. But the railroads of innovation are actually very well provided by the regulatory framework of the country as well as the financial industry in the country.
So the problem is internal.
Absolutely.
As for you.
Absolutely.
Okay. How are we making sure, or how someone like you making sure that automation stays accurate and trustworthy? Because when we talk about fintech, we're basically dealing with people's money here. So it's as serious as it gets.
Yeah, so I think it's a great example, and I think I'll give one analogy, right? We always are supposed to do a full compliance KYC of the customer, and majority of, let's say, incumbents in the category came and said KYC is a very tough process. Why can't I just use digital Aadhaar and just proceed on the consumer? Why is there so much of regulatory pressure to come into video KYC? Now we said, yeah, it looks like a problem. We need to figure out a solution because video KYC means slowness will come on our customer interaction. It means a video KYC will at least take 2 minutes for the consumer to talk to us visually, someone's to audit at the back, which means another 2 minutes goes away. Now, but when you look at that as a problem versus you look at a great opportunity, what we built at the back was not just doing VKYC more efficiently. It was about building risk management using that tool in a more efficient manner. See, what does the physical person when he visits your house or manual interaction at the branch do? It recognizes you, it tries to bracket you and come and says, listen, I think the customer earns this much, can pay so much. His questions deliver the same results when you go investigate the same thing in bank statements and at bureau. But imagine doing the same result using the video interface of the customer without him realizing that this is actually a step in him getting money rather than his step of completing compliance. When you change this entire interaction, it became just like the way you're using a system at the back end. The technology is far ahead, which means it can notice you, it can notice your background, it can notice your tonality, it can notice your retina movements, it can understand are you talking the right answer while telling you about your KYC, and at the same time able to build decisioning beyond the scorecards to manage risk in a better manner. Now, at the back, if you build this efficiency, you can manage this in a more tighter manner. You can build in more efficiency for the consumer. While you maintain your automation, it also maintains risk in a far greater manner. See, automation is always arbitrage to how much risk you want to take at the cohort, right? When you use automation as an advantage to risk management, suddenly you come out with much better results. And that is why as we automate further, actually our risk is coming down, right? Which is a very interesting result, right? We have gone maybe at least 10% more automation over the last 18 months, and risk has come down by at least 30% on the same cohort, which is a great result to achieve at an overall business opportunity.
I want to get in the investor mindset and the perspective as well, Ganesh. How do you judge whether a founder can navigate both innovation and regulatory compliance hand in hand?
I see that time's up, but I'll answer that question. Yeah, it's a tough one. I think there are known knowns and known unknowns. I think the challenge is with unknown unknowns, and with when regulation keeps moving, sometimes it's hard to figure out how to chase it. So there is that challenge. But that aside, I think there's clearly fintech is fintech for a reason. It's financial services first, and then how technology can help rewrite the landscape and rewrite the plumbing and do it in a lot more efficient way. So in most cases, I think you need to be able to assess founders on the ability to understand the existing system and ecosystem and the reason why the regulatory construct works in a certain way, to then know what you're trying to change and how do you want to change it. So that the ability to appreciate that they can understand both sides and then be able to design a solution is important. In most cases, that part is actually something we can gauge. What you cannot gauge is how regulation is going to change, and that's a wild card.
So, as closing comments, one real quick question for the both of you. Ganesh, I'd like you to continue. How do you see the funding environment change for fintechs in the coming year? In 2026, how are things likely to shape up?
And obviously, there is a lot more talk and hype around AI. While foundationally, I think AI is over long term, AI is going to help us do a lot more things in a smarter, efficient, more intelligent, knowledgeable way. And Akshay already spoke about some of the examples. In the short term, we are probably going to overestimate what it can do. So there's clearly going to be a lot more aggressive funding around that space. If you look beyond India, I think the two countries that are in a different orbit when it comes to AI, from an infrastructure, context, data, foundation, and apps, not apps yet, but getting there, are US and China. And countries which are getting smarter on AI have a much greater advantage than countries that are not. So we should be thinking of it in a lot more critical manner. It's not just India, but any other country is in a very, very, very different zone and is being left far behind compared to US and China.
Your thoughts, Akshay?
Uh, I think, see, funding is always available for people who are solving problems, right? I would advise, let's say, fintech founders, don't chase money. Money will chase you, right? We're in a business of solving a problem, right? Many of the times, if the problem is getting solved, you'll be surprised that money always comes, right? But remember the fundamentals of any business. Our business is really competing with people who have disproportionate money available with them, right? Which means we have to find efficiencies in how we deliver the last mile to the consumer, last mile to the business, or efficiently use that money to reduce risk, or efficiently use that money to collect better to build in more efficiencies, right? That's the fundamental of any core business. Getting the word AI or technology added does not change them, right? Some of these technology allow you to run your business in a tighter manner, in a smarter manner, a more presentable manner, and a more accountable manner, right? Not accounting manner, accountable manner, right? When you really put this umbrella, you will build fundamental businesses. You will not have to worry about, let's say, winters in investment, which are a cycle which keep happening, right? I think the good part is, I think the fintech winter, as we called it, is over, right? We are seeing multiple companies raising back-to-back money, and we see this is the current season where you'll see many more announcements over the next few quarters that many companies are raising more, going public, getting more recognition, getting more acceptance, and pressing the pedal on the large scaling program in the fintech community.
So, if winter is over, can spring be far behind? On that note, we'll wrap it up, guys. Thank you so much for sharing your valuable insights and your perspective and outlook on the fintech industry, how things are shaping up, and where it's headed. Thank you so much.